Well, good afternoon, everyone. And I have been looking forward to this panel. There's one subject that we seem to talk about every day here at Bloomberg, and that is real estate. And for the most part, you get a lot of negative news, but you also get some interesting opportunities. So that's what we're going to get to. And we have an amazing lineup. And I just want to quickly go through them. Jonathan Goldstein, CEO at Kane International, certainly familiar to our Milken audiences. He was on a panel with me last year. Richard Mack, co-founder and CEO of the Mack Real Estate Group. We have David Warren, CEO, Chief Investment Officer and founding partner of DW Partners. And then we have Jin Zhang, co-founder and CEO of Soho China. What's really amazing about this panel is that we are truly going to get a global look at what's going on in real estate. And I have to say, I have a ton of papers because just in the last 24 hours, I'm just going to quickly read you some headlines that came out with real estate. We had a $13.5 billion SPAC sensation that's buying your house. We're talking about Opendoor. We had investors adding more than $500 million to the iShares U.S. real estate in the latest session. You had asking prices for UK homes climbing to a record in October. Singapore home sales rising to the highest in more than 2 years. You had Cushman Wakefield coming out and saying, Asia Pacific office market, it is pretty much on the mend. You have Google in talks to buy a London office complex. And then for the first time in at least a decade, the French are the biggest overseas buyers of homes in London's wealthiest districts. However, if you look at hotel occupancy here in New York, it's not so hot. So it really is, depending on the market, depending on the asset class, you get a different story. So we're trying to look at where do we go from here. So Jonathan, we're saying real estate in the eye of the storm. Are we still in the eye of the storm? Are we on the other side of it? Or is it hard to tell still?
Oh, I think we're right in the middle of it, Carol. I think that anybody who thinks that the situation is over is, I'm afraid, a little bit misguided. I mean, if you look at this year, obviously, we've been 7-8 months, sat in our homes, bored, changing our lifestyles, operating in an entirely different way. And we've probably got another 6 to 9 months of this. So until we start to see some normality come back into our lifestyles, and until we start to see the real impact of the forbearance that the banks and the government support that's been given to so many businesses, and we actually have a real understanding of what underlying credits of various businesses look like and the impact that will have on real estate and the impact that it'll have on people coming back to the cities because they've been so scared to come into the cities over the course of the last 7-8 months. So I think we're right in the middle of the storm. And until we start to see some normality and some visibility of coming to the other side of it, we are really guessing about what the other side looks like.
Richard, do you agree? Is it 6 to 9 months more of this? How do you see it?
Yeah, I think we are in the middle of the storm here. And until we're through, which will probably be next summer, it's very hard to assess what the long-term impacts are of a very kind of unusual phenomena that we've never seen in any of our business careers. But as you remarked, not all asset classes are responding similarly, and there's both going to be growth in certain asset classes, growth in certain markets, and distress in many others. And so this is a really interesting time to be a real estate investor.
Well, let me bring in Shin because, Shin, I'm curious about what you're seeing. We were talking in the newsroom today that everybody's focused on what's going on in Asia. And I know we're going to dig a little bit more into your reopening, but when you look at the world right now, what do you see and what are you hearing?
Well, I'm hearing the rhetoric outside of China, outside of Asia, that people are really wondering, post-COVID, would we ever go back to working in the office? Would we ever go back to living in the city that we used to live? And I can tell you that, I've been through SARS in China and in the middle of this pandemic now. And in both times when the virus is gone, people went back to work, went back to live, went back to travel very, very quickly. And China is by now fully reopened. China was shut for the first 5 months of this year. And then by May, it was largely went back. And then by now, it's 100% reopened.
Okay, and I know we're going to show some pictures on it. David, let me just bring you into it in terms of what you're seeing. I thought it was interesting what Richard said. There will be opportunities, and certainly when it comes to distressed assets, and it really just depends on the different specific properties, if you will. What are you seeing?
Well, I think to use this storm analogy, we're clearly in the middle of the storm. And then the question is, are we also seeing a change in weather patterns? In other words, if you look back over the last 20 years, we've seen densification of offices, we've seen moves from people to the city centers and away from rural. And the question is, are we going to see some type of reversal of those patterns, which could have significant implications for real estate of all types? The reality is there doesn't feel like there's much of a storm in residential housing markets in the US right now. They're on fire. And I'll show some slides a little bit later about how home prices are doing and about how a month supply are doing, et cetera. But on the commercial real estate side, yeah, we're both in the middle of the storm, and we have significant questions about long-term use cases, which I'm sure we'll get into.
Yeah, we just did a story about Greenwich property, which we saw Greenwich property take a dip as a lot of financial folks were leaving, but now they're moving up again because people are moving out of the city. Shin, let's go back to you because, as I said, I think so many of us are watching Asia because you guys are ahead of us in this timetable when it comes to dealing with the virus, getting over it, and then reopening your economy. And I know you've got some pictures to show us as well. Tell us what life is like right now in Asia and in China specifically.
Can we show a few pictures?
Sure.
Yeah. Okay. So this is a office lobby in in our portfolio, one of the office buildings, and you can see that people are back to work. A lot of people wear masks, but largely, life has gone back to normal. In the earlier time, that the first 2 quarters of this year, we were checking. Where we installed infrathermal to just check body temperature of every person come into the building. We don't even do that anymore because China now has almost zero virus, so it is not required anymore. And you can just see that working life has definitely gone back to normal. And I think that's very important to once people feel safe, and it's not that hard to get back to how ordinary life is. I know outside of China, outside of Asia, people really wonder whether this is going to be a transformational change. Now, would people ever go back to work, the old ways? And people are so used to working online, and this is not the case in China because you can see that there are people just everywhere. And this is an office building, probably, just in the middle of the day.
Well, and I do wonder, and let me ask the rest of the panel, are you all watching Asia very closely to see how they are reopening? And I know everything isn't apples to apples, but I think I see, David, you're shaking your head. Tell me what you're watching here.
Oh, I'm going to try to avoid politics, but goal number one, get your infection density down, and then lots and lots of things are possible. We haven't quite done that in the US and haven't quite done that, Jonathan, in London.
No, exactly. I mean, goal number one, I would say, is testing. And I'm sure that's what David means by get your infection rates down. So I think that the Western countries, as an average, but certainly Britain and America as particular examples, have done a horrible job in managing a situation and thinking ahead about how we can get the cities and our businesses back to work. And what that's caused is, in Britain now is a new shutdown effectively in one form or other. And that's because of the lack of testing. We have no idea who is positive, who is negative, who's carrying the virus, who's asymptomatic, et cetera, et cetera. If we were able to get a handle on that, we'd be able to get cities and countries back to some level of normality much faster than we've already done. And once we've done that,
I'm going to argue slightly here and say that, yes, we've done a terrible job getting people back to work and managing the virus here in the U.S. But I do think that the U.S. is going to have some permanent changes associated with COVID. The U.S. is set up much more for a distributed workforce. There are many great secondary and tertiary cities and places to live. that I think is different than Asia, where people can find great universities, great hospital care, and outdoor and other type of amenities that make secondary and tertiary cities very appealing. And this trend was occurring prior to COVID, and COVID's accelerated it. Yes, I do think the big cities are going to be large and vibrant again once we have control of the vaccine. But I do think that we're going to see an accelerated pattern of people moving from the biggest cities. That's what we saw prior to COVID.
Well, it's interesting because I think that's one of the biggest debates we have, certainly with a lot of our guests, about this whole working from home concept. I mean, you have Boeing now looking to maybe sell its headquarters, and you have pick your tech company, right? Whether it's Microsoft, Twitter, and many others saying, you guys want to work from home for the rest of your tenure here at the company? That's fine. I'd love to talk a little bit more about working from home and whether or not we see this hybrid approach. Because Shin, you're saying, and I remember on our planning call, people want to come back to work.
People want to go back to work, and I don't know how permanent is the change if people wanted to stay, in a secondary cities or moving to secondary cities or stay outside of the city. Remember that just pre-COVID, there were times we were talking about how people wanted to work in the much more close environment, less square footage per capita, like the WeWorks, like the share offices, and that was just the debate or the discussion that we had pre-COVID. And I don't see how a virus slow down this process of people want to work together, because that we believe that really encourages communication, encourages innovation, and young people just want to be together, to work together. So I don't see how a few months or even a year staying more at home would change that fundamental human desire to be together.
And David, I think you said on the planning call that it's generational. And I think that's kind of what Shin's getting to. I mean, do you agree that there are older workers who are like, yeah, I want to go to the office. I've been going to the office for a long time. But younger workers are like, you know what, I like this flexibility. I can get work done. I was amazed. I talked with Meg Whitman, longtime, CEO at eBay and HP. And she initially in the lockdown was like, I can't believe after going to the office for 40 years, how much I can get done at work. But I do wonder if this shift sticks. David, what do you think?
Yeah, I think we should all take a pause when we're in the midst of this thing and try to avoid saying things are going to be radically different forever. I do think that we'll get an experimental phase where some companies will try to come back exactly to how they were, and others will be more experimental. All of us probably have employees with whom we work who have horrendous commutes, and I think they really enjoyed the being at home more and being more productive. But yes, the young people, the 23-year-olds, the 25-year-olds, they can't stand it. I don't want to say everyone, but for the most part, they can't stand it not having peers and not being trained. I can't imagine what it would have been like when I was 22 or 25, not having people from whom I could learn. And so I do think companies will encourage ways of getting young people and older people like myself in the room at the same time.
I think that it's a privilege of the privileged to work from home for as long as they wish to. And I think that people are forgetting the fact that businesses were born through vibrancy. They were born through a collection of ideas. They were born by people thriving off each other, by those snippets of conversations, be it in the pubs or in the corridors or over lunch. And I think that ultimately people will come back to where we started, because that's the way great companies and great businesses have been built. Now, there are one or two exceptions to that, people who can build great businesses out of their garages, but they're very few and far between. And ultimately, the reason that people come back to the cities is because we all like the great variety of assets that the city gives us. Human talent is attracted to the entertainment, to the media, to the sport, to the business, to the recreation, to all the various assets that a great city gives you. And New York City will be New York City in 100 years' time. So will London. And it may go through a blip at this point in time, but that will just be a blip.
Yeah, so I think radically different it will not be, but different it will. And I think we can't ignore that. Maybe we should. But we were already seeing issues with the densification that was going on in co-working spaces before COVID. And we were already seeing young families with children move either to the suburbs or to secondary cities. Those facts are certain. Now, whether or not this will increase the impact of those things, I don't think we know. But when I speak to other CEOs, the watchword is about flexibility with their employees. And that's going to change some things. The center of gravity will be the home office, but flexibility is coming into the lexicon of how people will work.
But what about industry differences? And whether it's the tech industry that always seems to do something a little bit different, or the financial industry, which is, it's been interesting to listen to the financial industry, the Wall Street banks, the CEOs, and some were saying early on, we need workers back, the productivity isn't as great, and yet they put out some pretty substantial numbers. But if you look at the Man Group and Schroders, they say they're going to shift to working from home during the pandemic. It's going to become the new norm for financial firms. So anybody have some thoughts on the financial industry, for instance? What happens?
Yeah, I think the financial firms are relying on capital that we built up and relationships that we built up, but I'm still trying to understand exactly how we build new relationships. How many of us have raised capital from investors who we've never had a dinner with, who we've never met in person? I think these are the things that it can be done for a short period of time, but I'm skeptical. I think a hybrid model, as Richard said, I think we'll see something like that. I don't think I'll be in the office 250 days a year like I was last year, but I think it doesn't work long term with the capital that you have to build up again.
Anyone else? Shin, do you have any thoughts on that in terms of industry variations when it comes to the commercial property market?
I don't see difference. I think it's human nature. And, do we want to work with other people together, or do we want to work alone? That's really the question. I think we all feel, this is a great thing about humans, is we want to be with others. We want to be with our co-workers, and ideas, would come out from these interactions. Only we feel better when we're in a team and in a group of people, with a group of people.
The reality is some work is collaborative, and some work you're better off doing in a quiet room by yourself. And I think the hybrid model will allow for that.
I certainly have done that. Go ahead.
I buy what Richard says, but I think that ultimately the weight of capital over the course of the last 10, 15 years, which has primarily been international in nature in the major cities, is attracted to those major cities because that's where the investors like to go to. And that's where they feel proud and they feel comfortable in investing. Now, there will always be a market in the secondary cities, always. And there will always be some very successful cities and they're outliers. But ultimately, they're small in nature. I mean, London has the same, you could argue, with Dublin. Dublin it may be a different country, but geographically it's nearer to London than many cities are to New York in America. But it's very small in nature. So whilst it has been attractive to international capital to a large degree, it doesn't compete with the weight, the transparency, and the liquidity that London gives to investors. So it's going to take a long, long time for these secondary cities to build up and match the weight of a New York City or a Los Angeles or a Miami or a London.
Well, I agree with that in terms of demand for assets, but I don't think that the gateway cities in the U.S. are going to grow as fast as some of the tertiary and secondary markets.
I don't disagree with that. I don't disagree with that, but I don't see that to the exclusion of the major conurbations. I don't see that as the major. I don't see New York City being on its knees in 3 years' time. It may be struggling now for leisure and various other assets, and because people don't want to come into the city. But I think the best analogy I heard was 9/11. I wasn't in America, in New York, in the month after 9/11, and I'm sure various of you were. But people could not envisage how after 9/11 New York would rebuild itself. And yet within 12 months, the Time Warner Center on Columbus Circle was trading at levels that had been unheard of in New York City.
I'm sitting in the Time Warner Center right now, so I lived through that. I'm sitting in the Time Warner Center right now. We were building the Time Warner Center and people said it would never sell. And
That's
so
why I used the analogy, Richard.
well, thank you. But I do believe in the resilience of New York, but there are some things that are a little different this time. Telecommunications, bandwidth, and already the rise in cultural and scientific and educational amenities in secondary cities and tertiary cities are real. So I think I don't think any of us are saying that people aren't coming back to the office. I don't think any of us are saying that the primary cities are going away. I think where there's maybe a little bit of difference is I think there might be a little more accelerated growth this time, especially in the U.S., in smaller places.
See,
Well, Shin,
Carol,
let me bring you in.
one more point. Sorry.
Go ahead, Jonathan. No,
So
go
I was
ahead.
going to say that I would just say that the flight to capital at this point in time, and David's already referred to it, is into residential, which is still strong, notwithstanding the narrative we've heard, and also, of course, into logistics. Now, we can all follow that herd mentality and deal with that, and I've actually got a lot of residential within our own portfolio. But it's the other areas outside of that that are going to suffer A, distress, and B, the greatest opportunity over the course of the next 12 to 24 months.
I certainly agree with that.
So, Shin, I want to bring you in because what are you seeing in terms of the tertiary or secondary, cities when it comes to Asia specifically?
Well, it hasn't really shown that much of a difference. Like secondary tier 2 cities in China have never been able to catch up with the tier 1 cities, and even with a massive population in China and with the incredible new infrastructure in these tier 2 cities. But still, I think talents and companies are largely attracted to tier 1 cities. In America, that might be different, but in China, that has been the case. And I also wanted to add one point is what we have seen in China over this October Golden Week, a 1-week national holiday, is that there was so much pent-up demand in travel. Hotels are fully booked, and restaurants are fully booked, and resorts are fully booked, and you could not move on the bund in Shanghai without pushing people around. So there was such a pent-up demand because people were so frustrated, locked down for a few months, and they were desperate to get out. And I expect that's going to be the case for London and New York. As soon as the vaccine comes out, people feel free to travel, feel free to interact with people.
I think Shin's right. I asked my partner Todd Bowley is a part owner of the LA Dodgers. And I suggested to him that, if the Dodgers Stadium was opened an hour before the game started, he said, I think 500,000 of LA residents would turn up trying to get in. People are desperate to get back to their normal ways of life. I tried to book a theatre ticket for this Christmas time because they're putting a Run of Les Miserables on in London. I was 40,000th in the queue and only logged in 2 minutes after the priority booking line started. So I just think that we have to live through this period. Life isn't changing otherwise.
But it's all about a vaccine in many ways.
Thank you for bringing up Dodgers.
I'm a Londoner, well, David, and I knew, David.
Well done. So, David, come on in and talk a little bit more about residential. I know you've got some slides for us to share with our group here. So talk to us a little bit about residential and what you're seeing and how it's maybe different from 07, 08.
Oh, yeah. Okay. So if you could put up the first slide, we started shifting a lot of our capital DW to financing home building and home builders a few years ago. And it was really this chart. This is housing starts year by year. You can see the massive crash in 08, 09. And that distance between the dashed line of about 1.5 million homes per year, which is what we think the population of the U.S. requires, and the actual homes we built, even though we overbuilt a little bit, you can see in 05 and 06, we haven't even caught up to 1.5 million. Now, December, January, February production, housing starts just before the pandemic, we're just above 1.5 million. So we really need a lot more homes in this country. There's been a lot of population growth in the U.S., and we just don't have enough homes. So if you can flip to slide 2, this has led to, this is going back all the way to 1963, and we're now at a record low of months home supply. And so what's happened is, think about the one thing you needed through the course of this pandemic. You needed a place to work, you needed to be at home, you needed to not have kids screaming, et cetera. And so the pent up demand for housing, it really stunned me. We turned down one home building deal right as the pandemic was started. Our capital provider didn't want to provide the capital. And then all of a sudden from the summer, the pent up demand for homes in the US has just been extraordinary. And so home prices have gone higher, but interest rates have stayed low, and that's made things very affordable. And we can play this by, on the debt side, believe it or not, by lending money to home builders at 10, 12, 14% rates of interest for them to acquire land and prepare it for home construction. The interesting thing is that they can get lending from banks at 2-3% interest rate for building the vertical homes, but it's the land and preparing the land for construction where you just can't get capital from banks. And this is, we were talking about, Richard was talking about geographical diversity. This is amazingly geographically diverse, this business, because the capital's all going to places like Tampa and Raleigh and Austin and Phoenix and Las Vegas, and the places where people are moving, the places where jobs are being created in the U.S., which really isn't here in the Northeast.
Secondary cities.
Yep.
Well,
And the other thing I think you need to do is lay onto that the production of multifamily. So one of the things that's happened is that we've had a tremendous spike in the production of multifamily. I think we're still not building enough homes, whether it's multifamily or single family, for demand. But we've drastically increased the multifamily supply, and we have not been producing enough single family, and we've seen more growth in the markets where single family is the prominent form of housing. And so I think it's important to kind of to take this holistically, and I think it just demonstrate that these secondary cities are growing pretty strongly.
How much, though, are we concerned about with money so cheap, and of course all of these, initiatives that were put in by governments to really help out homeowners? I think UBS came out and they had a report that talked about a real estate bubble risk in Munich, Zurich, some other cities because of that government support of personal income and also property markets. How concerned are we? And David, let me kick off with you. Concerned that we are creating some housing bubbles out there at the same time.
Yeah, I'm really not seeing those types of numbers. I mean, homes are still reasonably affordable. They were much less affordable in 05, 06, 07. We don't have bubble-like trends, and the income. We're talking about middle-class homes for people in Tampa. These are not million-dollar homes, and so I think if you want to talk about luxury condo in New York City, we can have a different type of conversation. But I'm not really worried about a bubble yet in places like Tampa, Austin.
Hey, Shin, what about your properties? Because it's mixed use. What are you seeing on the residential side of things?
We don't do that much residential in China now. We only do office now. And I wanted to mention just, as you said that, central banks have printed so much money, and with all these rescue packages around the world, we are, living in a prolonged low interest rate environment. And I think that would have a positive impact on real estate because, capital would be, chasing after, assets with steady cash flow. So I think that that would, as fixed income allocation would be reduced, I think, and then, some of that would be shifted to real estate as we continue to live in this prolonged low interest rate environment.
Another part of the market I wanted to talk to you guys about were warehousing and logistics and fulfillment centers. So I think, Richard, I know when we talked on the planning call, you had recently done a deal in Phoenix, and I think you said you were willing to overpay, but it kind of was a smart deal. Talk to us a little bit about that and what you're seeing.
Well, I think whenever you buy an asset, you feel like you're overpaying going in very often. And so, being able to be the highest bidder is always a precarious situation. But we've seen 3 years of e-commerce adoption happen in 6 months. And so I don't think in most markets we were adequately warehoused for that amount of growth. And Phoenix is a market that's not only growing rapidly, but from a distribution perspective, sits between the growth markets in Texas and Southern California, although it's not necessarily growing so quickly now. But those and Las Vegas, and so it makes Phoenix a very interesting place for logistics and distribution. But it's not just Phoenix where there's going to be opportunities. But the real question is, everyone is focused on the same technicals, and there is a tremendous amount of capital chasing beds and sheds. And so, if you want to get in there, you have to be willing to bet on the future a bit. And so, we're looking forward to continued growth buying in Phoenix at this moment in time. And I think anyone who wants to play in the distribution market has to pay up in anticipation of that growth.
Anybody else in terms of logistics or any thoughts?
Yeah, I wanted to share one thing is logistics different from the other traditional real estates like commercial, hotels, or residential. Is these warehouses are, number one, is very quick to build, and two is they're not as location sensitive. So they literally can build anywhere outside of the city. So in many ways, I think it's there's a greater danger of oversupply of logistics and warehouse than any other properties because of this nature.
Yeah,
Richard,
well,
does that? Yeah.
I think that it's hard to argue with that, except when you own logistics long enough and the city centers and the ring roads, which we have in America, grow outside of you, and now you've got a tremendously low basis in that distribution building, and you can knock it down and build an office building or a or multifamily. Look, I will say something that maybe I shouldn't, but Maspeth, Queens was once a swamp, and my grandfather built buildings at $10 a foot, and the rents are greater than that, significantly greater than that now. And those buildings are suitable to be repositioned. So yes, if you build them out in the middle of nowhere, you're certainly susceptible to that issue. But if you build them in close-in locations of cities that are growing geographically, there can be a double-sided opportunity there. But I'm not going to suggest that risk doesn't exist.
I do also want to ask about hospitality. We've seen the headlines, whether it's the hotel industry, the airline industry. It's just staggering. Jonathan, let me ask you, Kane, you guys own the Beverly Hilton. You are, normally Milken, we'd be there. You guys are doing this grand development along with the Waldorf. Where do you see hospitality kind of going and how long it takes for a recovery?
So I think that the base situation is that you have to have a right capital structure to live you through until you believe the market will return to levels which it was enjoying in 2019. Clearly, 2020 has been a washout and a disaster. And whilst in LA, in particular, we have rebuilt to some level of sensible levels, it's not going to rebuild to good points until tourists and business travel recommences. And that's not going to happen now, and it's probably not going to happen through the first and second quarters of next year. Maybe by next summer, we'll get back to some level of normality. So I think what you're going to see is, you're going to see a flight to quality. So you're going to see the best hotels continue to trade well. I was in the Connaught last week in London, and it was busy. I know that the Waldorf Astoria in LA continues to be busy. But obviously large hotels which depend upon group bookings and which depend upon conventions of one form or other or group meetings are going to suffer until we get back to the same point again, a sensible level of testing so people have confidence that they can get together. So I think we're going to see a lot of distress in the hospitality sector. We're going to see a lot of secondary and tertiary assets fail, go through levels of foreclosure. We're not going to see it yet because the banks are still being patient, but there's a lot of pain, and there's a lot of pain coming in that sector. And I think, as I said, I think it's going to be the area for the brave to step in and see through 22, 23, 24 till we get some level of stability. And I think you'll find great assets and great collections being built during these periods.
How brave are you going to be, Jonathan? Do you see opportunities that you want to basically
Well, I
step up
think
in
if you've
terms
got to
of
look at
possibility?
quality assets, and I believe if you believe in quality assets, then I think, yeah, I'm happy to be brave at the right time at the right price. I don't think pricing is there yet because I've said I think there's been the level of government support and banks forbearance, which has ensured that most people have not felt that pressure. But that pressure will come. Balance sheets will have been damaged for a very, very long time. And people will need to realize their positions as refinancings and as forbearance runs out. And when that happens, I'm sure there'll be some great opportunities around.
David, are you seeing an activity in terms of the distress side and kind of
Yeah.
deals being, yeah.
Yeah, definitely. I mean, most years when I've spoken at Milken, I've been on the credit conference. This is my first time on the real estate panel, and in credit, which is what we do. Yeah, there's been huge opportunities. There were opportunities all summer. If you think about it, you mentioned, Carol, before government support. There's been a lot of government support for many asset classes. There really hasn't been much government support for commercial real estate or commercial real estate debt. So you saw commercial real estate debt crash in price in many cases. And I'm talking about the way we played it was typically in commercial mortgage-backed securities that are not guaranteed by any government and are purely credit. And we tended to play in the spring and through the early parts of the summer in the single asset, single borrower transactions, which many of which were backed by hotels. And there you're making a 10 or 20 year play at hopefully very low loan to value ratios. And there were opportunities very quickly in April, and they kind of were gone by June or July. At this point, we're playing in the triple B minus sector of commercial MBS. And there are some acute issues depending on how much retail and hotel deals comprise those transactions. There really are not acute issues with respect to multifamily or office, and there you're looking at a longer term play about whether there will be longer term consequences and defaults and delinquencies of those. But you can buy bonds with 9 or 10% subordination, bonds trading in the 70s to yield 10%. This has not happened in a long time on pretty well underwritten transactions, not with a lot of retail, not with a lot of hotel or hospitality in them. So yeah, there have been terrific stressed and distressed opportunities in commercial MBS.
I want to bring in a couple of questions because there's some great questions coming in from our virtual audience. This one from Caitlin. Does the current softness in retail and office real estate present the opportunity for adaptive reuse that could help address the housing crisis in U.S. cities such as LA and San Francisco? And I know, Jonathan, I don't know if you remember from last year, but the real estate panel, we kind of got into this a bunch about providing more affordable housing. Does anybody have any thoughts about that in terms of the housing crisis?
Well,
I think Richard.
Go ahead.
Sorry, Richard.
Sorry, Jonathan.
No, I was going to say that
Richard,
I agree with what Richard said before about how the last 6 to 8 months has accelerated the retail trend so aggressively. And I think we are beginning to see situations where out of town retail centers can be repurposed, provided the pricing gets down to a level which supports it. You can see that occurring in very, very many areas around the US and the UK and Europe, where these areas can be repurposed for housing. We have an obligation to ensure that people have somewhere to live. And if we can provide it through repurposing these centers, that's something we should be doing.
Richard, do you want to come in on that?
I absolutely agree. I've heard it said before, and I should know exactly who to attribute it to, that we have about 1,200 malls in the United States, and probably about 300 or 400 will survive. The rest are going to have to become something else, and that something else, with the help of government rezoning, should be both distribution space, new types of retail, and more affordable housing. But I also think that there is an opportunity, not necessarily in repurposing office, which will take a lot more time, but perhaps in repurposing hotels. And we may see in some urban markets that hotel just doesn't fully come back, because while tourism may come back, it's not clear that office travel will come all the way back. And it's a little bit easier to repurpose hotel, absent the kitchens, if we get the right assistance from government into housing. And this has got to be a public-private partnership, because zoning generally doesn't allow permanent housing in hotel use. So I see a lot of opportunities to repurpose and solve housing crisis, but it's going to have to be a work of the government with the private sector in retail and office and hotel to help accelerate this.
Here's an interesting question. College and university campuses foster a very important community and house an incredibly large amount of students, faculty, etc. Any thoughts or strategies on how real estate will evolve around campus? We've done a lot of stories here at Bloomberg, just as colleges, universities have either shut down or everybody's at home, how it's affected certainly the local economy. It's not just the university and colleges being impacted. Anybody have any thoughts on that? Jonathan, anything you're seeing there?
Well, it's a great example, in my view, of where governments have got this situation so wrong. So I have an 18-year-old son. He started at university in the north of England on the 21st of September. And on the 30th of September, he and his entire apartment diagnosed positive for COVID. Now, the truth is, 2 weeks later, everybody's well, everybody's healthy, everybody's fine. It's flushed through the university. And within another couple of weeks, they'll be getting back to life as normal. So I think that the life of students should be promoted and encouraged, and people should be encouraged to get to colleges, because statistically, the number of people under the age of 45 who have been very badly affected by COVID is infinitesimally small. And as a result, I think the continuation of young people going to universities will continue. And in fact, we're in the process of investing in some student residential apartments in a major city in the United Kingdom, actually, because it's a growth area that will continue to be active for a long, long time. And it's a great different asset class away from the norm. And we should be encouraging people to get back to university, back to college, and we should be encouraging that by helping to invest.
Well, I'll take it a step further and say that I think that university towns are some of the markets that are going to grow fastest. And it's not just about students going back there. I think it's about older professionals deciding that that's where they want to live. It's where they want to raise their families, because you have a great intellectual base. You have a center of culture. You have restaurants and other amenities. And many of these college towns are located in places where the weather is fantastic, or there's a great outdoor lifestyle. So I think that college towns will come back, and they're one of the places which we think are going to grow faster than the rest of the United States.
I have to agree. I'm from a large family, and I have a lot of older siblings. And when they go to look for places to retire, they want to go near like a college town, just because there's such a kind of great community that's around there. Shin, I'm sorry, I think I interrupted.
Yeah, I just wanted to add one thing. I think I share with Jonathan's view that the students are dying to go back to colleges, and I have 2 college sons, and they're dying to go back and to be with their friends. And they're really, they see many of their friends already contracted COVID and then recovered. But I think the issues are not the students, are the professors, right? And the faculties. They are the older ones. They need to be protected. And if the students get contracted, then what happened to the professors and faculties?
No, but Shin, in England, all I can tell you is the UK experience. It is remote learning 90% of the time, but at least the children get to live their lives. Right? They've been cooped up since March. My son missed his graduation. He missed a summer vacation he was taken with all his friends. All these rites of passage that children have begun to expect being taken away from them. For what? But then they consider our homes and do online learning. At least this way, wash through it. You look at the statistics in England, in Leeds, in Nottingham, Edinburgh, Exeter. It's all the college towns where the numbers have spiked so hugely. But that's a good thing, because ultimately they're with each other. I can't get him home, let alone, So I think it's great. I think it's a good
Jonathan,
thing.
I agree. I've had a similar experience with my students in college.
Well, and I know some schools are doing where they're keeping the teacher sequestered, but the kids are together in a classroom so that at least there's a social aspect. Shin, there's a question I want to ask for you. It's actually from Michelle. Are any of the, and anybody can answer, but I know, I think this might be appropriate because I know you think a lot about kind of technology, the digital world. Are any of the panelists exploring investments in AI technology in regards to health and safety? Will there be a great relationship there? Shin.
Well, we went through SARS. I remember at the time people were so afraid of being indoor, and then we changed our building windows, from curtain walls to at least one. Every floor has a certain percentage of openable windows. That was then the technology of the building, and now I think it's about filtering the people entering the building. So we have all these infra thermal, everywhere, and then but you need more than just the technology. You also need the the environment where you're allowed to use the technology. And my understanding in the US is that you have the technologies, but you're not allowed to use them for tracing, for filtering, and that in China we don't have that problem.
Anyone else in terms of technology and the role in real estate?
That's a much broader question than around helping with COVID. It's a
Okay.
very long conversation. We have a panel just on that.
Yeah. Okay. All right. So we'll move on. The one thing, another question that came in had to do with climate change. How will changing climate, extreme weather events, rising ocean levels, wildfires affect real estate demand along the coasts or other vulnerable areas? If insuring a home from flooding or wildfires becomes unaffordable, will governments need to intervene? And I know we've had some programs in the US where local municipalities are actually buying up homes that are in just terrible areas only because it costs those cities to have to rescue people when there's storms and so on. So they're just trying to take those homes off the market. Climate change in real estate, is that something that's kind of on your watch list, or?
I'll share one
Shin?
story that we had because this is to do with climate. So two things is, for a while, you probably all knew that China was filled with air pollution, especially in cities like Beijing and Shanghai. And then so it was so bad that we were thinking as a developer, what do we need to do to filter the air? So what we did is we installed a air filtering system to all of our buildings, and knowing that humans, at least the Chinese in China in the cities are 80% of the time are indoor. So if we can filter the air indoor, we're probably doing some help. And so that's one thing to do with air. And another thing is we had discovered that so much of the energy consumed by the buildings can be saved by computer models with sensors in every corner of the building. That if we installed all these sensors everywhere in the building, and we have a computer model that monitors if there's a corner, there's no one is there, the sensor will send a message to the model and it'll shut the energy. That way, we're able to save 30 to 40% energy of the buildings.
That's pretty significant. Any other thoughts in terms of green or ESG?
Look, one thing that generally gets overlooked when we talk about green or ESG is that the most environmentally friendly buildings are buildings that are already built. And so we want to talk about saving the environment. We should figure out how to repurpose buildings as opposed to tearing them down and rebuilding new. But that is not the easiest thing to do.
It's expensive. It's right. And as you said, not easy to do. One of the things that I wanted to ask you guys, because we have about 10 minutes left or so, is, this was obviously the virus. There was also, I know for the US, we talked a lot about what happened in Minneapolis and George Floyd and, diversity and inclusion and racism. And I do wonder, whether you think about investments that you're thinking about inclusivity, whether it's with your suppliers or thinking about projects that you want to make sure that there's kind of a D&I component, maybe already. But I do wonder this kind of dual pandemic that we've been dealing with, certainly here in the US and perhaps elsewhere. I just wonder how any of that might factor in terms of your thinking. And David, maybe I'll start with you.
Yeah, we've looked at, who you work with, of course, what types of people you associate with. We've done transactions with large components of affordable housing. There are ways of getting at a social benefit as well as an investing benefit, especially, as has been mentioned a couple of times before, when you have the right public-private partnership.
Richard, any thoughts on that?
Yeah, sure. So, our goal is parity, and the way we get to parity is by expanding our network of vendors and of people that join the firm. And so we're really trying to reach out to non-traditional vendors, non-traditional universities to try to expand who we try to hire, and try to get to a firm and to a business practice that more closely resembles the population. But this is not an easy thing to do, and you have to do it in a way without discriminating. And so this takes a lot of work, a lot of patience, and we're trying hard, and we have a lot of our firm's energy focused at this.
Why isn't it easy, Richard? Why is it so difficult?
Well, because if you decide that you are going to try and hire more people of color, for example, then how do you do that without necessarily discriminating against other candidates? And so you have to be careful, because we don't want to discriminate, and we want to hire the best and brightest. So it's just not an easy policy when you want to move from a place where you're not at parity to a place of parity. And that means to get to parity, you probably have to overhire from some groups that have traditionally been left out. And so that process is not easy.
Carol, if I can just add in there, I agree that it's difficult, but fundamentally the problem is that the industry is full of people who look like me and sound like me, who are white, middle-aged men in their 50s. And ultimately that occurs because we don't start at the grassroots. We don't promote, we don't ensure that the right people are going through colleges or are going through apprenticeships or going through graduate recruitment schemes. And as a result, when it comes to hiring senior executives, the pool of talent from which to recruit ultimately looks like me again. And as a result, this is a generational thing. I was in the law before I joined the real estate industry. And I can tell you that I think the real estate industry is shocking by comparison to other industries. It's just worse. And it's worse because we don't do enough about it, and we look for excuses as to why this can't happen. That's not, not an individual issue. It belongs to all of us. I'm no better than anybody else. But unless we accept that generational change is needed, and that starts right at the bottom of the chain, people can't grow up. When I first looked for a right-hand person in London, I went to a headhunter and said, I want someone more diverse background than me. And the headhunter said to me, you're wasting your time, Jonathan. The pool of candidates from which to choose is too small. So I think that's where you need to start at the beginning. And once you get to the beginning, it might take 15, 20 years. And like many other situations.
It's absolutely going to take that long. But we have to start.
Unless we address it, unless the large companies and the agencies, the big international real estate agencies and the big international developers, unless we address it now, it will take another 15, 20 years from 5 years' time, as opposed to 15 to 20 years from now.
Maybe I wanted to say one thing is we can't even find enough women in the room in real estate industry. I so often see the room full of men. I'm the only woman in the room. That's what we're facing. I think we need to make our industry cool and fun because people are not attracted to real estate. We're boring, we're old, we're traditional, and that's something we have to change.
And let me say,
Well
making
said.
people work forever will perpetuate that inequality. It won't promote equality. Very
No, it's
easy
interesting.
from my nice house or from everybody I speak to in New York's been in the Hamptons, right? It's very nice from your home in your Hamptons or the nice home in London or in your countryside vacation place to operate equally. If you're in a one-bedroom apartment or in a studio apartment and you've got to operate, it's not so easy. So unless we understand that actually this is all linked together, all these narratives are linked together. And that's why I've been so surprised that some of the companies who are meant to be the most forward-thinking, the Twitters and the Googles of this world, have been the great promoters of people to stay at home. Because that's not the way they grew their own businesses, and that's not the only way they broke their own glass ceilings. So why are they imposing it on everybody else? It's horrendous as far as I'm concerned.
No, that was fantastic. I think you're mixing a few metaphors, though. But I like it. I'm just going to say.
I thought we had to do it. Listen, we only have like 4 minutes left. So I do wonder 1 year from now or approximately maybe a year from now that hopefully we can gather at the Beverly Hilton and do the next Milken Global Conference. What do you think the headline will be on real estate? And David, let me start with you. What do you think it might be a year from now?
Extraordinary pent-up demand for travel, causing a boom in everything travel related next winter.
I like it. Jonathan, what do you think it'll be?
I think that 12 months from now, people will be beginning to get their confidence back. People will be beginning to get back to some level of normality. And I think we will start to see a steady progress through 22 and 23 back to where we were back in 2019.
Shin, what do you think the
changes,
headline?
of course.
With change.
I'm not disputing there'll be changes.
What I think
Shin,
a year from now, I think a year from now, people are going to look back and say, damn, why didn't I invest in real estate at the time? It looked so cheap and no one believed that these offices would ever be occupied. And that would be the case.
And Richard, what do you think it'll be a year from now?
I'm going to take a slightly different view of that and say that we didn't end up seeing as much distress in the private markets for real estate, and those opportunities that were apparent were in the securities market to participate in the recovery in office. There was just too much capital sitting on the sideline and not enough distress.
Can I make one caveat? And I agree with Richard. Can I just make one caveat to everything? That governments make sensible decisions over the course of the next 6 months. That governments promote and understand that people need to get back to normality.
This is a prediction or a demand?
No, this is just a caveat.
He's crossing his fingers.
Well, we don't need a government.
I think New York may need more help from a governance perspective than just dealing with COVID.
All right. Well, listen, we could certainly continue. I wish you all to stay safe and be well. Thank you so much. We covered a lot of ground, and I know everybody appreciates your input. Take care, everybody. John, Richard, David, Shin, thank you so much.
Thanks
Be well.
Thank you.
Thanks, guys. Take care. And thanks, everybody, for watching. Appreciate it.